Welcome back to the Money Seat Podcast. Today we are looking at Dublin, California, and what the heck is happening to home prices there. So home prices in Dublin, California are falling at the highest rate in the entire nation. And not only that, but the neighboring cities of Pleasanton, Livermore, and San Ramon are also dropping quite quickly. They all rank in the top 20 in the report. So let's take a look at, first of all, where are these cities? So right now, here's a quick map of the San Francisco Bay Area. There's San Fran, there's Oakland, there's San Jose in the south. These are the cities right there. So there's San Ramon, Dublin, Pleasanton, Livermore, all in the same general area. House prices there are dropping at above 10% in all four of those cities. Dublin leading the list with a 15% year-on-year drop. So the average home in Dublin, California has just lost about $229,000 of equity between this time last year and today. That is huge. Pleasanton, Livermore, San Ramon not far behind. So what on earth is driving these massive drops? And the answer is, quite simply, it's the interest rate. So right now I pulled up a random house that's for sale in San Ramon just to take a look at what the heck is driving prices there. So this house here listed for $1.8 million, and right there, Zillow estimates the cost to be $12,480 a month. That's your mortgage, your property tax, insurance, HOA put together. If you want to get in this house and you can only put 20% down and you're financing the rest through your 30-year mortgage, it's going to cost you $12,480 in cash per month. If you want to rent it, Zillow is estimating that you can get about $5,000 a month in rent for this. So if you want to live in this house, you can either rent it for $5,000 a month or you can buy it for $12,480 a month. The cost to own is more than double the cost to rent. That is insane. That difference right there. A lot of people are looking at this and saying, you know what, I'd rather just rent. So this is driving up the demand for rent and driving down the demand to buy. So a lot of people are saying, I'm going to sit this one out. I'm not going to buy it. I'm just going to rent it. I can enjoy the same house. Now you might be thinking, yeah, but when you own the house, some of the $12,000 is going toward paying down the equity in the home, right? Okay, so let's take a look at that because it's a lot less than you might think. So check this out. If you have a $1.8 million home, 20% down payment, you have a 30-year mortgage at 7.25% annual interest rate, you have a $9,800 mortgage payment. In the first year, $8,700 a month is going toward interest. Only $1,100 a month is going toward equity. So even the $8,700 in interest is more than your rent, right? So people say, yeah, when you rent, you never get that money back. Yeah, if you rent for $5,000, you're never getting that $5,000 back. But that $8,700 in interest, you're never getting that back either, right? The interest alone is more than your rent. Now you might think, yeah, but if there's appreciation, that's where you make the money. The only way to make money on this play at this point is appreciation, right? Like this will never cash flow if you need to rent it, and you're spending $8,000 a month on interest that you're never getting back. So the only play here is long-term appreciation. And right now, these properties are falling at about 10% year on year in value. Now, what happens when it's this much more expensive to own than to rent? As I stated earlier, it's going to drive up the demand to rent. More people will want to rent, and a lot less people will want to buy. Historically, when this has happened, this is what it looks like. There's a great chart here from Reventure Consulting, so kudos to them for putting this data together. But this chart compares the cost to buy, which is the yellow line, versus the cost to rent, which is the blue line. And this data goes back 50 years. And what you see here is that over time, the two lines tend to converge, right? So the yellow line is the cost to buy. Sometimes it spikes. In the 1980s, it spiked because of high mortgage rates. 2008, it spiked because of high property prices. Right now, it's spiking because of high interest rates again. But every time it spikes, over the next 5 years or 10 years, it kind of comes back down and it meets up with the blue. So over time, the blue line keeps increasing, right? The cost to rent keeps going up year after year because of inflation. And the cost to buy, though, keeps kind of fluctuating. It has an upward trend, sure, but within that upward trend, there's big fluctuations. Interestingly enough, between 2009 to say 2021, in many parts of America, it was cheaper to own than it was to rent. There are still some parts in America where it's cheaper to own than it is to rent. But if you look at the blue line, it's actually spiking right now, right? Rents are increasing faster than they were in the past. Well, why is that? And I believe it's because of what we just looked at. It's a lot of people are choosing to rent rather than buy, because buying is it's getting harder and harder to justify. So now there's more demand for rent. So rents are now increasing at a faster clip than they have been historically. Rents have never increased this sharply in the entire 50 years on this chart. And it all started happening when interest rates started spiking. And so right now, this is a very interesting time to buy, and it's a very challenging time to rent. But this cannot be sustained. This is not sustainable, and this is now driving people to reconsider that purchasing choice and say, maybe I don't want to buy right now. And they're going to sit this one out, and they're going to see where the market goes, and they're just going to choose to rent for a while. Because when you're saving $7,000 a month in cash, you can invest it, you can hang on to it. It's much easier to prepare for a rainy day when you have $7,000 extra in cash sitting around every month. So keep your eye on this one. I think this is the start of a bigger trend. In 2008, 2009, this is exactly how that housing crash started. House prices started falling in expensive areas like Los Angeles and New York and San Francisco, and in places that were full of investors like Florida, etc. If this trend continues, look out. You're going to see big drops in the real estate market. And it doesn't sound like the Fed is going to lower rates anytime soon. They're waiting for some kind of a crash. But let me know what you guys think. Thanks.